Good morning, good afternoon. If anyone can hear me out there and see the screen, if you can give me a message in the question box, let me know that's coming through. There we go. Thank you, Scott and Charles. Good morning and good afternoon, wherever you are. We've got, who's this? Penny and Mila and Joey. Hey, okay. All right. Always need a few brave souls out there to, pardon me, let me know that things are coming out. I'm always worried about talking to myself out here. But excellent. Oh, we got a lively crowd today. Excellent. Always like that. That makes it more enjoyable. Well, welcome. My name is Roger Tricko. I am with Trade with Precision, and we are presenting today's program in conjunction with Nadex. And this is Nadex Premium Trading Strategy course, and you are part of part 1. So welcome. I commend all of you for being out here today. I think it's great that you have an interest in education. I'm a fan of education. I think it's excellent. And as long as you will be trading, education is going to be part of your life. So starting out here today, I think is a great way to do it. This is an advanced program, and once you get through the program, you will have a good starting point or continuation, depending on where you are in your trading, that will help you get yourself to the next level and to make you a better trader, which I guess, after all, that's what it's all about, isn't it? So that is excellent. Today is an interactive webinar, so that if you do have questions on the slide that we're showing, please go ahead and type your questions in the question box. That's why we have it. And we will, I will make sure that we get your questions answered so that we are clear on the material before moving on. Also, at the end of today's webinar, I will stick around for a few minutes in case you have questions on what we covered. We can go into a little bit more in depth at that point if need be. Again, the concept is making sure that you are familiar with what it is that we're talking about. And we have, look at that. First question is up. Will this webinar be recorded? Yes, the answer is it is being recorded. Mark, no sound. It's got to be on your end. You're welcome, Eddie. Let's see. I'm thinking Mark can't hear us. No sound. I'm going to take a second here to answer him typing because he's obviously not able to hear me. And must be on your end. Okay, now wait, back to our program. Okay, so I think that covers our intro. Welcome again, and let's move on. Oops, we got to click down here. Click here. There we go. Get into our legalese and take a moment to read through this. Just letting you know that today is for educational purposes only. We are not advisors of any kind, do not recommend any particular market. Yes, you can lose money. Give me another couple of seconds, give me a chance to wet my whistle. Okay, now that we've read through that, we go on to number 2. And this is another legalese. This one from Nadex, very similar to the concept of what we just covered. Take a moment to go through this. And if you are in agreement with these 2 disclaimers and warnings, please stick around. If not, then you are free to go about what you wish for the rest of the day. Okay, having gone through that, let's move on. Okay, something new, something up to date, something we want to make you aware of is that now, and make you aware if you weren't, with Nadex, you can now trade on all your devices. So whether you're using your smartphones or what have you, tablets or computers, you have this available. If you're using it on your smartphone, you can see over there on the lower right, Where you can get that, it's on the App Store, the Google Play, and download from Windows Store. So you can get however one you wish. And within these programs, you can filter your trading opportunities. You can search binary prices 0 to 100, get the one that you want. Fast, secure, flexible access, binary options, and call spreads. So you're getting both. You get your most popular markets available in real time. So even though it's on your smartphone and not on your computer, you're still getting the same fast access. The charts are customizable. You can fit them up the way that you want them. You can use multiple time frames, multiple indicators, however it is that you choose. You can view your open positions, any working orders that you have, and even your account balances. So you have just as much information as you are going to need. Yeah, there we go. All right. We got a good thumbs up there from one of our attendees today on that one. So what to expect from this premium course that we are just starting? This is a 3-part program, as you're probably aware, 1 per week. Today is obviously part 1. And as we said, this is an advanced education course. Today's webinar gives you the foundation for the next 2 sessions. Within the next 2 sessions, not today, but the next 2, we will be showing you 2 complete decisive strategies. These 2 strategies are the recipes that take the ingredients and put them into action. This is a concise and easy to understand set of rules. Rules are good. Rules are telling you what to do in a particular scenario. So this tells you right up front, so you know what is coming in, what to do, and how to manage that, so that you're not second-guessing yourself, and you know, and take the emotions. I guess what I'm trying to say, take the emotions out of that. We do not want to trade with emotions. Now, part 3 is entirely focused on trading. We're trading the call spreads and the binaries in various trading scenarios. So we're trying to give you we can't give you, pardon me, we can't give you everything because every trade is unique. But we try to show different things that, one moment. So I didn't want to cough in your ear. Because every opportunity is unique, we just try to give you some ideas of what to consider when you see different scenarios in that, to get you prepared for when you are out there putting your hard-earned money to work. Okay, what are we going to cover today? It is part 1. What's our agenda? Well, first thing is, we want, if you haven't figured this out already, we want you to consider what type of trader not only are you, but maybe what type of trader do you want to be, or are you going to be? Whoops, sorry. Is swing trading more of your preference, or do you prefer the faster aspects of day trading? We'll look at Nadex contracts, for swing and intraday trades, help you, once you've made that decision, which way do you want to go in terms of the type of contracts that would be more appropriate. Modern technical analysis. If you're going to be trading these fast trades in either swing or intraday, you'll need to understand technical analysis. And we'll show you how we do it, what we recommend, the reasons why, and how you can put this to use in your working day. We'll look at technical analysis versus a trading strategy. Yes, they are different. What are the differences, what they are, how to use that? We'll give you definitions. Again, I am a fan of definitions because everyone can then be speaking off the same page, so to speak. We'll look at trends. We are trend traders. If there is no trend, there is no trade. It's that simple. But so first of all, we have to determine, okay, here's a chart. Great. Which way is it going? If you can't decide which way it's going, you can't make a decision in terms of where to trade and how to trade that particular market. We'll look at moving averages. How do they complement trends? How do we use them with trends? We'll get into more of that later on. Today's program is, as we said, is more about the foundation rather than the strategies. We're trying to get everybody on the same page, definitions, understanding of what's what, how do we use them, this type of thing. Candles. You may have heard it as candlesticks. Those terms are synonymous. But we'll give you definitions of candles for those of you who are not familiar with that. Show you the benefit. Candles are wonderful. They give you a world of information. So they are great. Support and resistance. Some of you who have been out there trading will have used or have heard support and resistance. We might have a little bit of a different twist to it. We'll tell you how we do it, and again, why, which is better for understanding, which is good. And indicator convergence. Yes, we do use indicators. They are benefits. They are a benefit. They are a friend. They're going to tell us and help us determine how to do things and help us with our trading decisions. Okay, here's an overview, a quick thing on the precision. That's trade with precision. Precision momentum strategy. So if you were just looking at this chart and you were to say, well, okay, it's a chart. Do I want to trade this, first of all? And secondly, assuming that I want to trade this, which way am I going? And if this is a short trade, how many reasons can you come up for that? So if you're looking at this, maybe some people come up with some reasons. Maybe some people don't like this to the short side. Some people might. Some people will look at this and say, there is no trend. All those things come into play. And when we get to the momentum breakout strategy, we will be listing all of those reasons that why we would look at this as a potential trade. Comment here from our, yeah, okay, that was just a comment, not a question then, from one of our attendees. It's just keeping an eye on that question list. Okay, same concept here in the trend flow strategy. And as the name suggests, this is also a trend following strategy. So as we said, no trend, no trade. So here we have two different time frames. And looking at these two charts, how many reasons can you list for going long now? Can you, are you interested in going long? Do you think this is a benefit? Do you think it's a good trade or a good opportunity? All of these types of things. Again, we'll show you how we look at these charts, look at them in terms of the areas on the charts that we call zones that you would be trading, either a buy zone or a sell zone, depending on which direction you're going. We'll show you these during that session. But we just wanted to give you an overview of what the types of scenarios are that we would consider looking for a trade. So keep that in mind, and we'll start today by giving you the basics from which to build on. It's the foundation. It's no different than building a house. If you're building a house, you need a foundation before you can put up the walls. Same thing here. So here's our commitment, is that by the end of this course, not only will you understand why these are trading opportunities, but you will be able to spot them setting up for yourself and know how to trade them on Nadex. So I think that's a pretty good start to everything. This is what we commit to you, and I think that's a pretty good commitment and a pretty good goal to have for the end of this course. I'll let my whistle there. Okay, so we said we were going to help, if you haven't already decided, help you determine what type of trader are you? Are you going to be a swing trader? Are you going to be a day trader? And it doesn't mean that you can't be both, depending on your personality and lifestyle. So you have to take the time and a little self-introspection, because you need to ask yourself the question is, what type of trader am I? And also, what type of trader do I want to be? And you look at the analogy of an athlete, their physical and mental makeup might mean that maybe they're better for long distance running rather than short distance dashes. Same thing for you. Maybe you're better as a day trader versus a swing trader, or vice versa. And it doesn't mean that you have to sit in front of the computer 8 hours a day. You can choose to be a full-time trader, or if you're working another job or you have other commitments, who's to say that you can't be a part-time trader and still be successful? Success being your definition of success. Nevertheless, you need to make some considerations. You may be working full-time, part-time. How much time do you want to commit to sitting in front of the computer? Well, those are all things that you need to consider when you decide which way you're going to play. So we talked about definitions. Let's get into our first one today. So the two major trading styles, we have swing trading. Now this is a trade that is held open for a few days or even up to a few weeks. The objective is to capture the midterm move of a trend. You're looking at longer trends versus day trading, but you're still looking at the same concept, is looking at the trends. Now, because of that, swing trading is usually on the midterm to higher time frame charts. So these would be the 4-hour charts, 8-hour, daily, and weekly, because it will take that much time, a few days or a few weeks, for the trend to play out. So that's why we choose that particular or those particular time frames. Day trading, now you're looking at either having a trade open for just a few minutes or a few hours. And as the name suggests, your trades are opened and closed within a particular day. And you're looking strictly for intraday moves on a trend, not something long term. So because of that, day traders are going to look at the lower time frame charts, that being the 2-minute, 5-minute, 15-minute, or even 1-hour chart, because your trades are going to play out within that time period. Okay, so what's the difference? Well, the similarities would be that you can be trading the same markets. You can use the same strategies. So the two strategies that we're going to show you, you can use them either in swing trading or day trading. And you will use the same risk management protocol. Risk management being very key to trading long term. So what are the differences? Well, we showed you about the time frame, either longer term or shorter term time frames on the charts, and the trade length. Day traders are obviously within a particular day, and swing traders are for longer term. Now, trade with precision, that's TWP there at the bottom. Our specialty is trading strategy. The strategies that we are going to share with you, you can use anywhere. It's not just one type of thing. So whether you are a day trader or a swing trader, or want to be either, you can use these strategies and insights that we're going to tell you about during this course of the program in either scenario. So you have to ask yourself, which style is going to be best for you? You don't want to be doing something where it's a struggle. You want it to be easier. So consider that when you're working through this scenario for yourself. Now, most beginners are attached to a particular market or a style because somebody else said that and they were successful, or maybe that's just because that's what they said. Yeah, this is what I do and you should do that too. Well, there's other ways of doing it, and it may be right, but maybe it isn't. So understand what they're saying, but you don't have to be married, as the suggestion, to that type of scenario. You need to determine what is right for you. Now, some people believe that a particular style is the only way to make money. This is how I do it. I don't understand how anybody else makes money other than this way. Well, hey, I'm happy for you. That's how you do it. It's not the only way. There's multiple ways of doing it. So, how about some variables to consider? Personality. What type of style are you drawn to? Are you like the person who is high energy, wants things quick? I want to get in and out. I'm going to, snapping the fingers. Here we go. We're working. We're rocking and rolling. Then, well, okay, maybe day trading is better for you. If you're more of the long term, you want to trade it out, well, then maybe the swing trading. How much time can you dedicate to trading? Do you only have a few minutes, an hour or something at a time? Well, then that may play into it. When are you able to trade? Are you only trading before work? Are you trading at night after you put the kids to bed? All those types of things will come into play that you want to consider. And the market. Is there a particular market that's best suited to you? Are there times of day when that particular market is more active? You want to consider that. Because you want to trade when there is liquidity. It's tough trading when there's only two other traders trading this thing, and they're just watching the market. When you make a trading opportunity, you need somebody on the other side of your trade to take the opposite side. So think of these things, see which one works out for you, give it some thought. It's nothing that has to be answered immediately if you need time to think on it. So swing trading, how about advantages to that? Well, if you are going to be a swing trader, it will give you more time to analyze each trade. Because if it moves a little bit either one way or the other, it's not terribly crucial because you've got a little more leeway in how much room things are going to move. You can focus on a wide range of markets and asset classes, which gives you greater flexibility because now you have more time to look across a number of things. You don't have to be overly focused on certain things. It's a less intensive analysis, time is required for that. It's a little more relaxed. You get more time between trades because of this time period that's utilized in that. Then when one trade ends and another one opens, you've got time in between. So it's not as time intensive. You can do less time day-to-day management of that because your trades are going to go for a longer term. Your slippage and your spreads are less significant. Now, slippage and spreads are facts of life within trading. And, pardon me, one moment. Got a little cough here today. Wet my whistle. I gotta keep a little moisture today, a little dry. So lubricate the vocal cords here in a minute. The next time comes up. Okay. So slippage and spreads are costs that are just associated with trading. It's part of it. We have to accept it. We try to minimize it, of course. It's like anything else, but we recognize that it is there. Now, the higher time frame charts that we showed you, that 4-hour, 8-hour, daily, weekly, it can be less susceptible to market noise. Now, pardon me, noise is merely that fluctuation of the market between the swing highs and swing lows. So that's the definition of noise if you're not familiar with that. What about day trading? What are the advantages there? Well, you can become an expert, so to speak, in maybe 1-2 markets. The point being, you're limiting the number of markets that you're trading, but you become more experienced with them, and you can become an expert and be more knowledgeable, and you can pick up on nuances within that particular market. Good or bad, you are forced to make quick decisions. Markets are on those smaller time frames, markets are moving quickly. Trends play out more quickly. But you also have a lower risk of market gaps. Gaps are going to happen either overnight, over weekend, on news. But if you're in and out, you can trade around news events, those that are planned anyway and you know about. But you can also avoid those overnight and weekend gaps. More trades more often. You can fast track your learning curve because you're doing it more quickly. You'll get 10 trades done much faster day trading than you will as a swing trader, good or bad. Your trades, they're closed at the end of the trading session. You're out, you're flat. You are out of the market. So you're not worried. Have a good night's sleep. The outcome of your trading decision is known fairly quickly because your trade only takes a little bit to happen. When you've got that small time frame, trades are going to play out in a shorter manner. Okay, so now that the concepts is general, how about specifics? What about the Nadex contracts? Which ones of there are better for you? There are differences. Now, for intraday trading, both call spreads and binaries would be appropriate and across multiple strategies. Obviously, you'll need a directional bias, you need a trend, and then just pick out the right contract that's right for you. Now, great markets are available that are perfect for intraday trading. We can look at indices, commodities, forex markets. Great opportunities. Your expiration times, you get the hourlies, 8 hours, and daily contracts. Now, this is just a brief overview. We're going to get into detail in part 3. So, intraday trading scenarios, strong trends. You're obviously looking for the trending markets. If you can find a trend, there's a good chance that you can find a setup. Maybe not initially, not maybe right now, but you can see one coming down the road that you can take advantage. In the momentum strategy, you're looking for flat breakouts in the direction of the trend. With the trend flow strategy, we're buying and selling on the pullbacks following that trend. Economic news, we can trade these news events at the market open, find out which way the market is interpreting that news, which ways it want to go, and take advantage. The end of day volatility, a lot of movement, a lot of liquidity, a lot of volume. We can take advantage of that at end of day. Now, the two strategies are going to be covered in detail in part 2. As we said, today's building the foundation to get you ready for that. How about swing trading? Well, now swing trading, you want to utilize the binary options only. So I want to stress that. There are many weekly contracts and strike prices that are available for the binaries. The call spreads have daily expirations only. So we want to keep the call spreads strictly to intraday trading, the day traders. Now for markets for swing trading, same ones. We can use the indices, commodities, forex. These are all available for swing trade with your binary options. So these are some great markets that you can take advantage of in which to trade. So how about some scenarios? Well, within the momentum and trend flow strategies, These are universal strategies. It's not specific for any particular one. Oops, I'm sorry, let's back up here. How about, we have a question here. How about touch brackets? Not familiar with touch brackets there. We had 2 questions on that. Yeah, well, probably getting beyond what we're looking at today. Hang on to that question, and it's a new Nadex product. Oh, just started. Okay, then you got me on that one. Separate webinar. There we go. Okay, thank you. All right. Yep. Thank you for bringing it up. And no, I'm not familiar with that. I'll have to. I'm glad you mentioned that. I'll have to get more involved in that. Thank you. So the higher time frames, we can focus on the 240, which is your 4-hour chart, the 2-hour chart at 120, or the 60-minute, which is the 1-hour time frames. Beginning and midweek training. There's great setups that occur throughout the week. And remember, your time value decreases as the week goes on. So you can take advantage of that. Okay, we want to get into technical analysis. We want to show you how we do it. And you can use this technical analysis in any scenario because it's going to help you to get that set up in a way. I'm going to make a note here. Okay. Okay, so let's show you what we have. First of all, let's get into some definitions. Technical analysis versus trading strategy. Now, the line often gets blurred because a lot of things talk about technical analysis, which is great. It's a good education. But we want to create a difference between them. And let's use an analogy here, a simple recipe, maybe by a baker, if any of you who like to bake or cook. So a recipe, basic tenets. Describe what ingredients are required. If you're making a cake, you need flour, eggs, milk, water, whatever to make that. So in trading, we have the required ingredients, and that's the method. So what's the purpose on the recipe? Well, the purpose of a recipe is to make sure that the desired outcome is achieved every time the baker attempts to recreate it. Now, the recipe itself is the set of rules, and these set of rules have to be followed to a T to ensure that desired outcome is achieved. If you have your set of rules, that's great. But if you have your set of rules and you say, well, I'm not going to follow number 2 today, and well, number 4, yeah, not really, but I'm still going to do it. You're putting yourself against the wall, and you're decreasing the odds and probability of success. So you have to be careful of that you do follow your rules. Now, the technical analysis, that's the ingredients. You want to make sure that you have more cons than pros in the traditional sense. You can't bake a cake with just one ingredient. So now, if you have more cons than pros, then something you don't want to take advantage of. You can't bake a cake with just one ingredient, as we said. The trading strategy is now the recipe. This is essential for your trading success. It combines multiple technical factors, and it turns the ingredients into a recipe. And we have a question here. I'm unable to continue. Oh, okay. All right. So somebody's just bowing out. There are replays, but it's not until the program. Oh, he's already left. All right, never mind. Okay. So let's move on. Traditional technical analysis. And we're not traditional, but we do absolutely use we use technical analysis, just not in the traditional manner or the manner in which things were created, we put a little twist to it. Now, traditionally, technical analysis would include head and shoulders patterns, double bottoms, sloping trend lines, MACD crossovers, the dead and golden crosses, overbought, oversold zones. These types of things, they were effective, but you miss out on something because they are a lagging indicator. Lagging indicator means hindsight. You're looking to the past to see what it is to try to make predictions for the future. It's like driving looking in the rearview mirror. Not beneficial. Modern technical analysis is what we're going to show you today. This is the trade with precision style. We use some of these things, but with a twist on that. We are looking at this from how we have developed it over time. Our technical analysis tools are from a leading approach, not a lagging perspective. Okay. We're going to look at trend analysis. That's the first thing. So we'll start working on our checklist here. Trend analysis. If you don't have a trend, you don't have a trade. That's simple. Moving averages. Do they reinforce what the trend is? How do they compare to that? Your candles, your candlestick patterns. What are they doing? Candles tell us a world of information. Support and resistance. We need that. And indicator convergence. Do the indicators tell us, or do they confirm what we anticipate seeing on the chart? It's going to help us make our trading decision. If it's saying yes, what you see is right, great. If they're saying nope, what you see is not right, well, you got to say, well, this trade may not be for me. Okay, first up in the hit list, trend analysis. Understatement here, single most important technical tool. Yep. If you can't determine what the trend is, you're not going to be able to make a decision of which way to go. At the same time, if you can't decide which way the trend is going, you probably don't have a trend. So that helps out too. No trend, no trade. So a wealth of information is just from price. We can make all sorts of decisions just looking at price action. The expression, price action rules all. Now the indicators are a second level. They're the confirmation. It's the icing on the cake, so to speak. We think we have a trend. Well, what does the indicator say? The indicator says, yeah, you got a good trend. Great. Off to the races. It's the analysis of the peaks and troughs, the highs and lows, give us the indication of who's in control. We need to know who's in control. Is it the bulls or is it the bears? You can have the bears in charge within an uptrend and vice versa. Both of the strategies that we're going to be teaching in the program require trend analysis. Okay, uptrend. One moment. Sorry. Uptrend. Okay. Once again, we need a definition. Definition of an uptrend is that price action needs to be making higher highs and higher lows. So what do we mean by that? Let me get my cursor down here. So here's the start of the trend. Okay, it's moving up. We have a swing high and it pulls back as we would anticipate, and it turns around and says that's far enough, we're going higher, and off we go. So we have a swing high and a swing low. In and of itself, it doesn't really tell us a whole lot. But now price action moves up. We have another leg to this trend, and buyers run out of steam, and they stop buying, so we roll over. We come back in, the buyers come back in and push it higher. So now we have a second swing high and swing low. So these are only important when we compare them to where we were before. So this swing high is obviously higher than this previous high, so therefore it is a higher high. We look at this swing low and compare this level to this price level of the previous low, and we see that this swing low is higher than the previous low. Therefore, we have a higher low. Higher high, higher low. That is the definition of an uptrend. When price action moves above this price level, this horizontal price level, after it breaks through, as long as it's higher, we have at a minimum a new higher high, regardless of how far it goes. Okay, what about mirror image? We have a downtrend. What's the definition here? Same concept. Now we're looking for lower highs and lower lows. So we start out here, we move down, we run out of sellers, turns around, we have a pullback, the buyers run out of steam, sellers come back in and push it lower. So we have a swing low and a swing high. Price action falls down, falls lower, run out of sellers, price pushes higher, we have a new swing low and a swing high before the trend continues. Again, we compare this swing low with the previous low, and we see that this is a lower low. We compare this swing high with the previous swing high, and we see that this is a lower high. Lower lows, lower highs, definition of a downtrend. As soon as price action breaks through, goes lower than the previous lower low, this downtrend is still intact, regardless of how low it goes. It's just lower than it was previously. So that's our definition of the trends, the uptrend and downtrend. That definition comes into play when you are looking at charts. So what happens if you have no trend? What does it look like? Well, we start out, we have a low. Okay. In and of itself doesn't mean much. Now we go higher. Well, okay, now we don't know which way the market's going. Now we come down. No, we have a lower low. Well, maybe we're going to start a downtrend. Market moves up. We have a higher high. Well, how the heck? You got a higher high and a lower low. What definition does that come under? Well, it doesn't. This is no trend. Market is just going either sideways or just going all over the place. And it's ranging, it's consolidating, it's creating a base. Lots of terms that you can come up with as to what to call it. But the bottom line is no trend. And as we said, no trend, no trade. Just have to wait for this to find its direction, see which way it's going, and then we can look at it and make a determination of, okay, this is now in a trend, now I'm looking for opportunities and go from there. All right. So the changing of a trend. So what happens here? Well, we start out with a trend, and we start out with a downtrend. So what happens? Well, we start here and we move down. This low is lower, so we have a lower low, lower high. Trend continues. We're moving up. We pull down. As of this point on the chart, if we were looking at this in real time, as of this point, the downtrend is still intact. We're still within, come on, cursor, come back here. Side note, the cursor goes away if I'm not using it. It feels neglected. So anyway, so as of this point, we're still in the downtrend. When we fail to break lower than the previous lower low, we start to be suspicious that maybe this trend is no longer going to continue. Once we break above our previous lower high, the downtrend is done. It is invalid because we have higher lows and higher highs. That is not a downtrend. So now, once we have broken through this lower high, and we know that the downtrend is not intact, we start looking for opportunities. We're looking to see, are we going sideways or are we going to be creating an uptrend? And in a simple reversal in this scenario, we have our initial low. Actually, it's a higher low, pardon me. This would be our initial low. This is a higher low. We've broken above our previous lower high, so we have a higher high. So now we're looking to see what happens on the retracement. Retracement pulls back, turns around and goes higher. We have a new swing low. Compare it to our previous swing low, and we see that it is a higher low. So now our uptrend is valid. It has reached, or it has followed our definition. So now we can say this is an uptrend. Prices move higher, higher highs, higher lows, all well and good. Now, as of this junction, if we're looking at this in real time, as of this point, our uptrend is still intact. It is still valid based on price action. Come on, cursor. What happens? We fail to break above this higher high. So this is a swing high, but it is a lower high compared to our previous high. So now we're suspicious that this uptrend may not continue. So we want to observe if price action falls through this previous higher low, and anything below that is now a lower low. Our uptrend is no longer valid. This has either changed from an uptrend to sideways action, or will be changing to rolling over into a downtrend. We'll have to watch and see what is what and how that plays out. Okay, and lubricate my vocal cords here. Okay, so what is the trend? Let's look at some scenarios. We have chart A. Pardon me. What do we have in chart A? Well, I think it's pretty easy to see that prices are going lower. Even without having to do anything, I think most people can say that, yeah, okay, this is a downtrend. So what do we have? Let me get my pen out here. Let's be precise and make sure everybody knows what we're talking about. I need a color. Let's do pink for the ladies. Okay, pardon me. So we have, so right now, where are we? We're here. We're here, so there's lower lows, excuse me, lower highs, pardon me. We got here and here and here. We're making lower lows. So we have a downtrend. Now, for those of you who are astute, you can say, hey, wait a minute, that low is higher than this low, and you are correct. Now, what we don't know is which way it's going. So because we have not broken above that high, we are one of two things, either going to be going sideways. Well, I take that back. You can always go one of three directions, up, down, or sideways. Right now, we're suspicious because we failed to break through there. So we're going to have to see. If price action breaks up, the downtrend is invalid. If we roll over and come down, the downtrend is still intact. Okay, how about B? Well, again, not too difficult to see that this is an uptrend. All right, well, there's a high. Looks to be pretty flat at the moment, so we're waiting for that to break up. this way. Here's a low, here's a lower low, here's the high. So we've got higher highs, higher lows. Pretty easy on that one to determine that this is indeed an uptrend. Okay, how about C? What's going on over here? Well, we're obviously low here. There's a high. It's a little mixed. There's a lower. So we can say this is just starting a downtrend, coming out of an uptrend, went sideways, and now we appear to be heading down. We had that reversal. Here's your consolidation of no trend area. So between, in hindsight, here and here, you don't have a trend, but it's not until it plays out that you'd say it's no trend. Actually, there's a low there. So once we broke that low, the uptrend was invalid. So right about where my line was. And then it goes sideways. We get a little bit of action both ways, but now downtrend is in place. So that's how we would want to determine what is what and find out what kind of trend that we have. Okay, let's erase and go back to my cursor. Okay, there we go. And moving on. Okay, so moving averages. Let's look at this. This is the next step that we have. Once we determine the trend, we want to look at these moving averages and see what they are telling us as well, because they're going to help us with this trend in terms of which way we're going. Now, as we know, price action doesn't go in a straight line. It moves. As we saw in our textbook examples previously, we had it move up, it pulls back. It moves up, it pulls back. So it moves around. So now what we consider that is sort of a wave. If you look at the waves, you can see there's the peaks and the valleys, the peaks and troughs, if you will, and that's pretty much how price action moves. Now, it's these waves that offer us an opportunity to join that prevailing trend as price pulls back into an area of equilibrium. Now, the definition of equilibrium is the changing of the guard. It's those turning points, the swing highs and swing lows, where the sellers are running out of steam and the buyers are coming into play, or vice versa. That balance starts to change, and right when it's the tipping point equals out. You may have heard of the expression "buy the dip." It's in a small sense of the way it's similar to that concept. Now, moving averages identify these levels of equilibrium, these areas, these zones, and it is a great technical analysis tool. So we like moving averages. We want to use them. Okay. So the benefit of moving averages is that they allow they create a smoother trend versus the changes within the price action. I guess you can say it's the closest thing that we'll have on the chart to a straight line. Now, what is a moving average? Well, a moving average is very simple. And if we think back into school, and the teacher taught us about averages, and they said, here's 10 numbers, add them up, divide by 10, and that gives you an average of those numbers. Well, we do the same thing here. We take the last 10 periods, we add them up, divide by 10, and that gives us a plot on the chart. A new candle closes, we drop the 11th one, we have our new 10, we add those, that gives us a new plot. That's all it is. Now, there are two types of moving averages. One is called simple, and the other is called exponential. If you have never heard of exponential, that's fine. You don't need to. Using the simple is very appropriate. If you are already using the exponential moving average, that's fine also. Go ahead. the concepts that we're showing today will apply to either the simple or the exponential moving average. But so you don't have to use one or the other per se. Now, because the 10-period moving average only has 10 periods within its definition. Now, I say period because it is regardless of time frame. And it is the same for every time frame. It's 10 periods for whatever. Because there are only 10, it's going to change the fastest. So it is always going to be closest to price action. The 20-period moving average has the 20 periods in it, is going to be also a quick moving average, just not as fast as the 20. Now, the 50-period moving average is going to be medium term because on a daily chart, you need about 50 periods, which is not quite a quarter of a year in terms of trading periods. So that's sort of a medium. And the 200 is for long-term trends. And that's what they're looking at. We're looking at highlighting what the particular trend would be for that market that we're looking on. So now let's give you our use of moving averages. Some traders will use moving averages as a support and resistance line. And we don't follow that scenario. We don't follow that philosophy. That's not how we think. We also do not follow the scenario where we would take a trade when price touches a particular moving average or when there is the crossing of two moving averages. When we analyze this and look at how this plays out, if price touches or there's a crossing of moving averages, this is a lagging indicator. We're looking to the hindsight of what things are playing. Moving averages are dynamic. They're moving, obviously. These are trend lines that indicate sensible buy and sell areas, but indicate a suitable price equilibrium level. So that's what we're looking at. That's how we would consider that. Moving average geometry. You probably wouldn't think about geometry in this scenario, but you'll see how we create that, or why we use that term of geometry. Now, correct from our perspective, moving average, that's the MA, geometry, is key to finding a strong trend. Now, if you're looking at your moving averages, we're looking to have them all to be either rising or declining. Obviously, we want them following price action in the same trend. We want to see that all of the moving averages are rising or declining at a similar angle. So we don't want one being ideally flat and the other one being steep, that type of thing. We want to have space between them and that they're creating a fanning pattern. So as you can see in this example, the angle of our moving averages, here's your 10, 20, 50, and 200, that's pretty close to about the same angle within that. Perfect. That's why it's a textbook example. Also, there is space. Notice the space between these moving averages. Notice that there is not much space, if any at all, in this area. That's the contrast here. They're fanning. Think of the oriental fans with the wooden slats and the paper between them. Well, the moving averages represent the wooden pieces, and the space between them is the paper creating the fan. That's why we say it's the fanning pattern. If you can have all of that, this is going to indicate a very strong trend, and one that we would want to potentially take advantage of. Okay, buy and sell zones, our golden rule. So here we have an uptrend. We can see that pretty easily. Our moving averages, 10 and 20, are in the proper order. We see that there is space between them. this creates our zone. Now, we look for buying opportunities in, but just as importantly, around the zone. So this is not scientifics where we're measuring with a micrometer the precise bands of the 10 and the 20. Notice the dotted lines. The analogy is to think about somebody in kindergarten, young student in kindergarten, and someone gives them a crayon and a coloring book and said, here, color in this book. Well, they don't have much experience. They're going to be coloring a little bit outside the lines. And that's sort of what we're talking about here. It's in and around. It's not precise. It's in and around. Now, how much in and around? Well, that's the art of trading. The science is, this is the zone that we're talking about. The art is your particular definition of where that is. But as long as it's close, is what we're saying. Okay, so that's the buy zone of what we're looking for when price action pulls back. This is the area of equilibrium. Notice it's not just touching. We're waiting for that to pull back into there for that area. Same thing on the mirror image going down the short side when we're looking for selling opportunities. Notice that we have opportunities here, not as clean as when they came back in between the 10 and 20. Now it's more delineating of showing that we're in and around this zone. We're close enough. That's the expression, close enough for government work, as they say. So we're in the ballpark kind of thing, and that's okay. Let's see if I can lubricate my vocal cords here. All right, overextension. You can have too much of a good thing. Now, we obviously always want our trades or our price action to go in the direction of our trade, in our favor, in the direction that we anticipated. But what happens over here on the left? We have our down market. Maybe we're in it. Ideally, that would be great. Things come down here. Look how far away we are from our moving averages. Take this distance from here to there. That is a big distance. Notice here, this is in and around your sell zone. That's what we're talking about there. That's within, around. So what do we have? So what does it mean? Well, the term is overextended. We've gone beyond. We're stretching an elastic band when we come out this way. Notice mostly how price action hovers pretty close. Yeah, it pulls away and then comes back to our moving averages. But now we've got over-exuberance. In this case, the sellers are getting carried away. Something really came out, bad news or something, that pushed this market lower. So when we see this type of trade or this type of market, and we see this push, in this case, to the downside, are we looking at this and saying, wow, what an up, look at this move, I got to take part of it, and we sell right there? Well, hopefully not. Because what happens? When we get overextended, just like that elastic band, it snaps back to equilibrium. So here's this candle that was in process over here. We had our low. It pulls back into the moving averages. So when we get overextended, this is areas where if you're in the trade, you want to start looking to get out. And if you're not in the trade, you're not looking to get in. You're waiting for the opportunity for this to come back, equilibrium, for taking advantage of that pullback. So we always have to decide what's going to be next. We don't know this, but we want to have to interpret what's going to happen and make our best guess. on that. So yeah, things is going out, all my things line up. Okay, now it's a trade. So we start over here. Market's pulling down. Wow, okay. We pulled back. Oh, okay, now we're in the sell zone. Maybe that's going to go further to the downside. Certainly setting up that way. How about this guy? Well, we can see it's an uptrend. Pulled way up there. Overextension. There you go. There it is right there. Big distance from here to our moving averages. What happens? The elastic band snaps back to equilibrium. Notice we were away, but we stayed fairly close and then pushed up, pulled back. Well, maybe we're back into the zone of equilibrium. Maybe prices go higher. What about this one? Well, prices are certainly going up. Where are we here? Big distance between here and here. It doesn't mean that prices can't go higher, but it does mean that the probability of this kind of move between these two candles from here is unlikely. So we would not be buyers of that particular market at this point because we appear to be overextended. One of two things happening, assuming that's the case. Either this market rolls over and comes back as we did in the middle slide, the middle chart, or we just kind of hang out in here and the moving averages catch up to us. Either way, price action and moving averages come together. Okay, candlesticks. We said that candlesticks were great. There's candles or candlesticks. They are individual. We look at them in terms of what they create as a pattern in a sense. For those of you not familiar with them, we're going to go into that now. Some of you may have gone out and spent money on learning about candles and candlestick patterns and learning the names and all the different things that can go with it. That's fine. No objection. What's important is that you know what the candles are telling you, regardless of whether you know the name of it or not. If you haven't spent your money on the program of learning what the candle names are, it's okay. You don't have to. What you do need to do is learn what the candles are telling you so that you can then interpret that when you see them on the chart. And that is what you need to do. Okay. Now, the background, they did originate from the Japanese markets. They were created there and brought over to the Western world and educated and very effective. At a glance, the benefit is that you can tell who's in control. Are the buyers pushing prices higher, or are the bears pushing prices lower? So we want to go through, there is an anatomy of the candlesticks, and we can tell whether a candle is bullish or bearish, and that's what's most important, in addition to where it is that it's occurring. Because you can have a bearish candle within a bullish trend, and in and of itself means nothing. It's just a little bit of that noise that we talked about earlier. Okay. A lot of information out there on candles and patterns, and there's probably hundreds of candlestick names out there. And that's fine. I don't put anybody down if that's how they do it and they can be effective with it. That's great. For my purposes, it's just more learning, more memorization than for me than I need to have. So I went through that. So I've been through learning the candle patterns and such, and I found that for me I didn't have to. Okay. What's important is who's in charge. Which way is the market going? Is it going up? Is it going down? Is it going sideways? Is it reversing? Is it getting ready to reverse? This is the story that our candles are going to tell us, and what we as traders are needing to be able to interpret. Okay. There are 3 types of candles. Why are there only 3? Well, which way do markets go? Markets are only going up, down, or sideways. And this is what the candles tell us. So let me get my pen. There we go. Okay. So green typically means bullish. Okay. So we know this is a green candle. This is bullish. This means the buyers are in charge. Okay. The green section of this candle is called the body of the candle. The line above and below is called one of 3 things. It's either called the tail, the wick, or the shadow. Those terms are also interchangeable. It just tells us where price action has gone. So with this candle, we know it was bullish. So we see that right there, that is the opening price for this time period. This is the low of the time period. This upper body is where price action closed, and this was as high as it went. So the wicks and shadows have the range of the candle, and the body just shows where it opened and closed. Next one, we have a green candle. Let me erase this other one. So now we still have a green body. Let me clarify, a green body. So we know it's bullish, so the buyers still in charge. And we know that we opened here and we closed at the high of the period. So that's bullish, closing at the high. And we notice that we rejected, because we know this is the low down here. So price action opened, it went down to this, price action was rejected, and came back up to close at the high. So this is what this candle is telling us of what happened. This is the story that's going on within this time period. Okay, how about this guy? Well, there's no body. There's just a line. It's a cross. There's just a line here. What does that mean? Well, think about that. Here's the line. So this is the open. Here's a line. Well, that's the close. We opened and closed at the same level. That's all that means. When there's no body on there, we open and close at the same level. Now, because this is near the upper region of the candle between the top and bottom, this makes it a bullish candle because price action was rejected all of that lower area. So that makes that bullish. Okay, let's erase that. Okay. Seller's in charge. It's a red candle. Red means it's bearish. So that we now know that we opened here and closed down here. And we went as high as this and as low as that. All right. Mirror image. This is bearish because we rejected that whole area in addition to being red, and that the body is at the lower portion of the candle. Open and closed, same level. We're at the bottom of the candle. Doesn't get much more bearish than that. All of this was rejected. It went higher and the seller said, no, we're going back down. Okay. Now, what about the third type? Indecisive. This is your sideways action. It's not only is it sideways action, but it can be, depending on the following candle after this, a change of direction. It could be equilibrium. It could be the buyers and sellers are evening out. Right now, the sellers are in charge. Here's the amount of sellers. There's only a few buyers. Here's the a few sellers and a lot of buyers. Down here, kind of equal. Now we see our open and close is right in the middle of the candle. So now we have equal rejection of top and bottom. Well, what about this one? This is green. Shouldn't that be bullish? I mean, we opened higher than we closed, rather, excuse me. We closed higher than we opened. Well, that part is true. But again, we're in the middle of the candle and we rejected up and low. So we ended up pretty neutral. Same with these. Neutral, yes, we did close higher than we opened. Here we closed lower than we opened. But we're in the middle and we have a lot of rejection above and below. Yes, there is a little bit of rejection above and below up here, but look at the size of that body compared to the total candle. So that's how we determine what is what here. And we look for these indecision candles for that potential change of direction, where they're coming down and we change and then maybe we're going back up for reversal. That's it, folks. That's what you need to learn about candles. Oops, I got to go back to my cursor there, don't I? Cursor. There we go. Now I can click here and move to the next slide. Now, that's how you read the candle. What about the size? Is the size of the candle important? Well, yeah, it is. Small candles offer the best opportunity for trading. And this is when we're looking for entry. Why do we think that? Well, it's these small candles when you have that indecision, that equilibrium. Neither the buyers nor the sellers are really pushing the market. They're kind of feeling the way around. One side is running out of steam, the other one's just starting to come into its own. If we contrast that to the large candles, remember those big moves that we saw with that overextension? Those large candles, big moves. In that example that we saw, I think it was the sellers that were really pushing the market down. And I gave the example, oh, look at this big move, I'm going to get in now. No, that's a bad place to move. That's when the amateurs get in. Stay away from getting into trades after big candles. We look for the small candles, the equilibrium, the changing of the guard. That's when things get in. That's going to be interesting because when we can get in at that point, then we can take advantage of that move to maximize the benefit. Vocal cords. Okay. Support and resistance. Kind of a tug of war as we see here. And some different ways that people look at support and resistance. We'll give you reasons and show you how and why we do things the way that we do. Sloping trend lines. And maybe some of you have seen these before or may possibly even use it yourself. Okay, definition. Get back to geometry. Your geometry teacher taught you 2 points make a line. Okay, all well and good. Here's a chart, and for our intents and purposes, here's a starting point. Here's our first point. So now we need to choose a second point in which to draw our first line. Okay. Market moves along, it pulls back, it moves higher. No, let's take this one. There's your straight line. Okay. What do we do with it? Okay, we topped out here. And we come down. Oh, we topped out here too. Well, let's draw a line across. Okay, what do we do with that? No, nothing came out of that one. Well, let's go back to where we were. The market's moved a little bit now. So we start back here. Oh, here's a point. Let's take this one. Here's the swing low. Let's see what happens here. So we draw our line, we go up, and yeah. Not sure what we're going to do with that either. Well, let's come back again. Markets moved around. Here's another swing low. Let's take that one. That didn't do much. Now the markets moved again. Let's take another one. And here's a swing low. Don't do much with that. I know. Let's go to the top. Here's our swing highs, and here's that swing high. Let's connect that. Wow. Okay, so we've got 1, 2, 3, 4, 5, 6 lines on here. How are you going to use those? You get more lines on here than you do candles. I'm being facetious. But it's very subjective. So it makes it very difficult to take advantage of that. So what do? Well, we say it's true support when you have horizontal lines. Support and resistance, once again, 2 points make a line. We follow the same thing. Support or resistance needs at least 2 points. More is better. We say at least. And it's not, again, it's in and around, within a few ticks. Many times, traders have orders that are waiting around these areas of support and resistance. And as price approaches these areas of support, their order gets filled, causing the reaction in price. And let's see, and we have a question. Do you know of anyone who makes a living as a Nadex trader? Can you share any success stories? How much income? Yeah, that's a very private question, Randall. But considering how big Nadex is, just as a general thinking about that, you've got to have people making money in this deal. Otherwise, they wouldn't be sticking around. So yes, there are people who do trade full-time as a living with Nadex, and yes, they are making money. How much? That's a personal information from their perspective. So, yep, you can do it. It is possible. It's just a question of personal interest and willingness to put the time and effort to learn how to do it and do it appropriately. So, hope that helps. Okay, so here's our support on the chart. Down here, here's our first hit. That doesn't mean anything. But when price actually comes down again, hits it again and pulls back. Now we have our 2 lines. We can extend that to the right, and we can see it comes down close enough before being rejected and then finally breaking through, etc., etc. So that's what we're looking for in terms of support. True resistance. Again, same concept. We need at least 2 touches. 2 points make a line. These are horizontal. We're looking at the same price going across. So in this example, this is, I don't know, call it 72.60. I don't know. Pick a number. That's what they hit here. That's what it hit here. And that's what it hit here before finally breaking through. But this is creating resistance. The more touches, the better. We have opportunities to trade when price action breaks through these horizontal levels. Notice how price action comes through here. It holds. Ba-ba-boom. We break through. We can take advantage of these opportunities following the direction of the trend. We have a question. Excellent question. Are the charts set for a specific time frame? And the answer is no. This is on any time frame. So if you're a day trader, you're going to be using this concept on shorter time frames versus a swing trader who's going to be using them on the hourly, daily, whatever, or time frame. But yep, good question. So this is where we are. Support becomes resistance. So we're coming down here. Here's support. Again, we're in the ballpark. We're close, we're close, we're close, we're close. We finally break through here. We can back up. Here it's support because price is above our horizontal line. Here it's resistance because price is below the line. Support becomes resistance. Resistance becomes support. So as you break through, it holds there. So here it's support, there it's resistance. Should it break through and retest, it holds as support there. This is the strength of these lines. And finding and utilizing and understanding these flat levels is critical to our momentum strategy. And we have another question. Would you use different moving averages or for different time frames? No, David, I wouldn't. I use the same moving averages. The reason being is that they are period moving averages. So if you are on a 1 hour chart, each candle is 1 hour. 10 period moving average is 10 periods of 1 hour. If you're using a daily chart, each candle is 1 day. 10 period moving average would be 10 days on that. So it's the same concept. So no, same numbers on that, same moving averages. Okay, indicator convergence. We're trying to measure momentum to see if the trend is going to continue. And we need to look at the strength of the trend and the strength of the moving average patterns. We can get a secondary measure of momentum by looking at our indicators. Remember, they're our friend. The most reliable trades occur when both price momentum and indicator momentum are in agreement. They're both going in the same direction. They're both going up. They're both going down. When they do that, this is called convergence. We like convergence. Convergence is good. It says, take that trade, trader. Now, we use what's called the box, out-of-the-box standard settings for these indicators, meaning we don't change anything. When you're on your platform and you click on MACD, this is what it's going to come up with, the 12, 26, and 9, and then the RSI 14. The difference is we don't use them the way that they were created. What we do is use them as a leading indicator to determine our convergence rather than hindsight. Convergence gives a greater probability of continuing. Let's see. Question. What is a good way to predict when the support or resistance will break through from the horizontal line? Rod is looking for the magic answer. Your question goes into the strategy of the momentum breakout. And so it's a great question, but hang on to that for that portion of the program, and we'll give you all the details at that point. Yep. So we want to use these. They are leading indicators, and this is how we use them. So we have a downtrend. We can see that. We're making lower lows in terms of price. So if price is making lower lows, we would anticipate that our indicators, our indicators would also be making lower lows. So here's our lower low. We come straight down, look at our MACD. Oh, that's making a lower low. Okay, that's good. Come down again. We look at RSI. All right, that's in the ballpark. That's making a lower low. Notice we're not worried about how high the indicators come back. We're only looking at the direction of the trend. The direction is down, so we're looking at the lows. Here's a lower low in price action. Indicators are lower also. Lower low, indicators are lower. This is bearish, meaning direction. We're in a bearish market. Bearish. Convergence, we're all in agreement of direction. We're all going in the same trend. There's your definition. How about definition of bullish convergence? Well, as we just decided, bullish is the trend. We're going up. Convergence means we should be in the same direction. We're making higher highs. What about our indicators? Well, if we come straight down, Okay, there's our baseline. We're making a higher high. Well, that's higher. That's higher. Higher price, higher indicators. We are in convergence. The indicators are converging. This tells us that the trend is likely to continue in this direction. No guarantees, but that's what we anticipate. Okay, that concludes part 1. So what's up for part 2? Well, hopefully you've already signed up for part 2. And within part 2, we're going to be looking at the hows and the whats of chart patterns. What do we want to look for? How can we take advantage? Multiple time frame analysis. We're always about trying to improve our trading probabilities. Reward versus risk. This is helping us to determine, is it a good trade? Can it be a good trade? Where do I put my targets? We'll have the 2 strategies that we mentioned, momentum breakout strategy, trend flow strategies. And to help you get started on that, we'll have some practicals, the strategies in action. I think you know the website, www.nadex.com. As I say, if you haven't, please make sure that you register that. Let's see. And let's see. Take a screenshot of the previous slide. Sure, let me back up here. Let's see. Velma, I think this is the one that you were talking about. If so, go ahead. I'll leave it there for a minute before moving on. But that concludes our program for today. As I said, I will stick around. If you have questions on what we talked about, please go ahead and put those in the question box. Oh, David, no, that's okay. You got to have fun. No problem on this end.